Amortization. This is another cost recovery. We are dealing with intangible assets now. We dealt with tangible assets, personal property, real property, dealt with briefly depletion, all that good stuff. Now we're dealing with amortization. Well, this is a method used to allocate the cost of intangible assets over their useful life for tax purposes. For certain intangible assets, the IRS allows straight line amortization over a period of 15 years, regardless of the actual useful life of the asset. Now, dealing with business organization and startup costs, this is a whole class of expense, and this is actually something that you will definitely see, you have to memorize for the exam. Business organization costs are the expenses associated with creating a corporation or partnership, such as legal and accounting fees. Startup costs are the expenses incurred before the business begins operating, like market research, advertising, legal fees for drafting the corporate charter, and employee training. You may see questions that you have to determine what is a business organization startup cost versus what's just a normal business cost. And that's important because, well, only business org and startup costs get included in questions like this, whereas other ones are just normal expenses that you're going to find on other tax returns. Now, according to the IRS, a taxpayer can expense up to $5,000 of each. So $5,000 of organization costs and then $5,000 of startup costs immediately in the year the business begins, subject to a phase-out threshold of $50,000. For each dollar exceeding that $50,000 threshold, the $5,000 deduction is reduced dollar for dollar. Now, this rule, it's been important. Just make sure you memorize it. 180 month, 15 year, same thing. It's just multiplying it by 12. $5,000. This has been pretty consistent. The remaining costs that are not immediately expensed in that first year can be amortized over a 180 month, also known as 15-year period, starting from the month the business begins operating. So you not only deduct this, but you can also begin this right away. It's not like you have to wait a year because you got your immediate expense here. We'll see examples of it. Make sure you practice questions that deal with this topic. Now, stock issuance costs, such as underwriting fees and commissions, are not considered deductible or amortizable expenses for tax purposes. Instead, they're going to be treated as a reduction in the proceeds received from the issuance of the stock and affect the stock basis for the shareholders. So just some tricks you could see in the questions. They try to get you to include these sort of costs. Really, we're thinking costs that are necessary and specific to get the entity ready, up and going. And the IRS is just determining that raising capital, which is essential for a business, but the IRS is essentially saying here, money you are spending to raise capital through stock issuance, underwriting fees, commissions, these are not going to be included here. They're treated differently. It's time to see some examples dealing with the amortization of startup costs. Let's assume that ABC Corp has a business organization cost of $57,000 and startup costs of $54,000. Now, since the costs in both of these cases exceed the $50,000 threshold for both organization and startup costs, the immediate expensing of $5,000 for each will be reduced. How does that work? Well, for organization costs, the immediate expensing, we're going to see that it's $5,000 subtracted by the amount over the $50,000 that it is. So that's essentially canceling it out, right? If it's over $55,000, you're not getting anything. The remaining amount to be amortized is $57,000. As such, the monthly amortization is going to be $57,000 divided by 180 months, and you're going to start this right away. $316 per month annual amount, just multiply that by 12. Same exact process here for the startup costs, except we are going to have $1,000 that we can immediately expense because $5,000 minus the difference between $54,000 and $50,000, that gives us $1,000 remaining. The remaining amount to be amortized is $53,000 because we can take this $1,000 in the first year, or not first year, I mean immediately. That is in the first year, but that is immediate as well. Monthly amortization, $53,000 divided by 180 months gives us $294, and then multiply that by 12 for the annual amount. Now, in this example, we can expense $1,000 of startup costs immediately, while the organization costs do not qualify for immediate expensing due to the phase-out. The remaining organization costs of $57,000 and startup costs of $53,000 are going to be amortized over the 180 months. We've got annual amortization deductions of the two amounts that we saw above. Nothing to it. You got this. You will knock it out of the park. All right, more examples here based on what we've been seeing. Let's say company ABC Inc. decides to issue new stock to raise capital. Here's an example illustrating the treatment of stock issuance costs, as we kind of mentioned before, but now we're seeing them with numbers. ABC Inc. issues 1,000 shares of stock at a price of $50 per share. The total proceeds would then be $50,000. However, in order to issue those shares, get them in the hands of willing buyers, investors, we had a few costs. We had underwriting fees of $3,000 and commissions of $2,000. That gives us total stock issuance costs of $5,000. Now, since stock issuance costs are not deductible or amortizable for tax purposes, they're going to be treated as a reduction in the proceeds received from the issuance. In this case, how does that look? Well, the net proceeds from the stock issuance are going to be the $50,000 of total proceeds minus the $5,000 for the issuance costs, giving us $45,000. The stock basis for shareholders will be affected by the stock issuance cost. The basis per share, this is important because basis is quite important as we know throughout the exam, will be calculated as the following: $45,000 divided by 1,000 shares. So instead of $50 per share basis, it is actually $45 per share. In this example, the stock issuance costs of $5,000 are not tax deductible, but they have effectively reduced the proceeds received from the issuance and affected the stock basis for the shareholder. All right, here are more intangible assets that are going to require amortization. These are going to deal with that same 15-year period using the straight line method. So Goodwill, you buy a company for more than it's worth. This is going to create the asset of Goodwill. However, it is an intangible asset, and this is going to be amortized. Now, the value of a business's reputation and customer relationships that contribute to its active ability to generate future earnings. Covenants not to compete. So that's also another intangible asset. Agreements that restrict a party from engaging in competitive activities within a specified territory or industry for a certain period. Franchises, the rights granted by a franchisor to a franchisee. These are the trademarks. If you want to open up McDonald's, you are a franchisee. Use the trademarks, trade names, and business system in exchange for fees or royalties. So that's an asset that you're going to, again, tangible asset, you are going to amortize that. Trademarks, distinctive symbols, logos, you know what a trademark is. Trade names, names used by a business to identify itself, its products, or its services in the marketplace. That is intellectual property. Licenses, any legal permissions granted by a licensor to a licensee to use certain intellectual property, such as patents or copyrighted material for a purpose or period. Permits as well, government-issued authorizations that allow a business to engage in a particular activity or use certain properties such as airwave frequencies for radio or television broadcasting. Another great example, the just legal recreational marijuana business blowing up in the United States and probably will continue to do so. And every year you're watching this video, it's going to be more and more. Those licenses, those are permits from the government. Those are going to be intangible assets that would require amortization. Like a completely random example, I know. I'm just like to talk about what's going on in the world. Customer-based intangibles, customer lists, circulation bases, and other similar items that have quantifiable value due to the relationships they represent with customers or subscribers. Supplier-based intangibles and contract-based intangibles, well, the value of favorable relationships with suppliers, such as favorable contracts or exclusive supply arrangements. These are all valuable intangible assets that you're going to have to amortize. And the value of certain contractual agreements, such as leases, employment contracts, construction permits, operating agreements, or other similar items. There we go. Keeping in mind, regardless of the actual useful life or contract term, we are going to use the 15-year amortization period. That's going to be a trick on the exam. They're going to try to get you to say, oh, we have a covenant not to compete for 8 years. Nope, doesn't matter. You're still using 15 years. Oh, maybe it's 20 years. Nope, you're still using 15 years. All right, these are intangible assets that are not subject to amortization, and some of them make some common sense. Indefinite lived intangible assets. Well, if there's no useful life, something like that, that would not be amortized. Examples are going to be perpetual trademarks or trade names that have no legal, contractual, or regulatory expiration date. Instead of amortization, these are subject to impairment testing, which assesses whether their carrying value exceeds their fair value, something that we see in the financial exam as well. Impairment costs, impairment expense, goodwill and other intangible assets not acquired in a business combination. So goodwill and intangible assets that are internally generated, such as those arising from R&D, marketing, or other activities within the company, are generally not amortizable for accounting purposes. However, these internally generated intangible assets may be subject to impairment testing. There's a lot of going on there as well, where generally speaking, for financial book purposes, you cannot have internally generated goodwill. It's not how that works. Not that we'll have to really dive into this too much on the tax exam, but just something to note there as well. Training costs, the costs associated with employee training, these are not going to be considered intangible assets and are generally expensed as incurred. Now, some of these things, the reason they're here, you might think it's random, but it'll be tricks on the exam, multiple choice question answers that they're commonly trying to get you to fall for. Here we got an example, just an intangible asset upon acquisition. Calendar year taxpayer purchases a new business on August 1st. The contract provides the following price allocation. So customer list was worth $120,000. The trade name for the business was worth $60,000, and there was goodwill generated of $80,000. Now, the current year amortization deduction, let's see how we calculate that. All of these are normal intangible assets that we would amortize over 180 months. None of these are startup or organization expenses. So for the current year, they're amortized for 5 months since the business began on August 1st. Keep in mind the dates. That's something that'll mess you up no matter what exam you're taking. In this case, we are only doing 5 months. We're not doing a full year. We're not doing half a year. We are doing 5 months. So 5 months, $260,000 in total of intangible assets divided by 180 times 5. Another wonderful example. We got a few more slides and we'll call it a day. All right, here on March 14th, in connection with the purchase of all the assets of Astoria's business, Maya Company entered into a covenant not to compete with Astoria for a period of 4 years, with an option by Astoria to extend it to 6 years. The amortization period of the covenant for tax purposes would be 15 years. So he said, regardless of all these other distractors, right, they're trying to get you to think that maybe you amortize over a 4-year period, maybe a 6-year period, maybe a 10-year period. Nope, all distractors, it's 15 years. Now, intangibles such as goodwill, licenses, franchises, trademarks, and covenants not to compete may be amortized using the straight line basis, 15 years. That's our rule. Drilling it into your mind. That is what we are going to do every time. The option to extend the covenant does not impact the amortization period as it's still within the 15-year time frame. The actual duration of the covenant also does not impact this, as again, the standard time frame for amortizing this is 15 years. Regardless of the actual length or regardless of what's happening in reality, we are using the IRS's tax rules of 15. Alrighty, another great one down. Let's wrap it up with a good old summary. All right, more examples. It's the best way to learn. I love it. Tech Innovators, a calendar year corporation, purchased and placed into service office equipment during October year 2. No other equipment was placed into service during year 2. Now, under the General Makers Depreciation System, we must use the mid-quarter convention here. When a taxpayer places 40% or more of its property, other than certain qualifying real property, into service in the last quarter of the taxable year, the corporation must use the mid-quarter convention for makers depreciation purposes. I'm just beating this to death because this is really the main thing with these questions you could get tripped up on or get wrong in the exam. So you are getting the repetition here to make sure you know it, practice it yourself, study it, memorize. With this method, the acquisitions are segregated by quarter and treated as if placed in service in the middle of each respective quarter. That's why we saw the Q1 table, Q2, getting you familiar with the exhibits that you'll see on the exam. All right, coming along here, assume you purchased an asset for $10,000. It's got a 5-year recovery period under makers. Under the half-year convention, the asset is assumed to be placed into service in the middle of the year, and the depreciation rates for a 5-year recovery period are as follows. You see these amounts, you might be starting to get a little familiar with the percentages as well. Again, just taking another look at how this works mathematically. Right? We take that $10,000 and just run it through those percentages. But we also see that in the first year, since it's treated as if it was placed into service in the middle of the year, we're going to have to do times 0.5 or divided by 2, just keeping a note there. So this is a 5-year life, but we are doing half of a year in year 1, half of a year in year 6. So good examples for mathematical numerical examples. Note that the total annual depreciation amounts do not equal the original basis of $10,000. It just occurs when using the half and mid-quarter conventions. I noticed this a while ago when I was, went back when I was studying, and something I knew I'd have to address here. And don't worry about that too much. Kind of the combination of rounding errors as well as this is just how the tables work. But if that was something you noticed as well, then you are observant. All right, same as the prior slide. Assume you purchased an asset for $10,000. It has a 5-year recovery period under makers. Now assume the asset was placed into service in the last quarter of the tax year, and more than 40% of the total depreciable basis of the property was placed in service during this quarter. So if it's just one asset and it was in the last quarter, then basically because of that, we would use the mid-quarter convention. In this case, as we said, we would use that mid-quarter convention. The depreciation rates are as follows. Then we would pull up the proper table from the exhibit, and here's how we would calculate the depreciation. Again, just running through this, it may be boring, and hey, I don't know how it could be boring. You're going through questions with me. But these are great examples, really, of what you'd see in full-on sims on the exam, right? So that $10,000 times 5%, then continuing on. And again, reference the tables. If you want to pull them up in our resources, feel free, so you can have them in front of you as you're checking these out for examples. Now, as illustrated here, the half-year and mid-quarter conventions affect the depreciation calculations, ensuring a consistent and fair approach. That's just something And whether it's bankruptcy or cost recovery or anything, that's the rationale. We're trying to make everything fair and equitable. Is that how it ends up being? Oh, not at all. But hey, that's life. Just trying to get through it, survive it. Moving on to the next. All right, some miscellaneous points here on maker's depreciation. If an asset is disposed of before the last year of its applicable recovery period, only half of the depreciation for the year should be taken. Now, disposed, that means either just thrown out, it was destroyed, or you sold it. So, in any capacity, it was disposed of. Now, the quarter year convention method must be used for all personal property if more than 40% of the total personal property was placed in service during the last quarter of the tax year. This convention also applies to the property purchased in the last quarter. The quarter year convention does not apply to real property. These are just some points we've seen as well. Want to make sure that you have those memorized. The maker's depreciation tables are adjusted based on the quarter when the asset was placed in service. The percentage values in these tables have already been adjusted to account for the quarter year convention. And lastly, when disposing of an asset under the quarter year convention, a half month of depreciation is taken in the month the asset is disposed of. Again, this is going to ensure that the appropriate portion of depreciation is claimed in the final year based on the actual time the asset was in service. As you see, the IRS, they've thought of everything, right? They are on top of it. They are making sure we are following the rules in a fair and balanced approach. Now, here's kind of more of a recap. Nothing here too new except for probably point 5 dealing with bonus depreciation in section 179. We'll deal with those later on. But if you wanted to recap, take a look through this slide. Not going to spend time reading it. It's a lot of what we've seen before, but just more practice, right? Repetition. The more you see these numbers, the more you see these concepts, the better off you'll be. Similarly, here we've got points on real property under makers. This is something, again, I would highly advise you take a look at. I'm going to go through the last paragraph here. The maker system employs a mid-month convention for real property, which assumes that the property is placed in service or disposed of in the middle of the month. Consequently, regardless of when the property is actually placed in service or disposed during the month, half a month of depreciation is taken for the month of placement or disposition. This means that the first and last year of the depreciation schedule is going to have 11.5 months of depreciation with full 12-month depreciation for the years in between. All right, more examples here. Let's assume you purchased a non-residential property for $1 million, including land valued at $200,000 and the building valued at $800,000. So that's the breakout there. And the important point there is we see that, well, of the $1 million, the full amount's not getting depreciated. We have to subtract out the land because land is not depreciable. So calculating the maker's basis depreciation there, we are seeing that we are taking out that cost of the land. Then what is the amount of depreciable years? Well, we know that for that non-residential property, that's going to be 39 years because you have that memorized by now. For sure, you got that. Calculate the annual depreciation, divide the depreciable basis by the number of depreciable years. Here is our annual depreciation, $800,000 divided by that 39 years. Now we're going to apply the mid-month convention. Assuming the property is placed in service in June, the first year will have 11.5 months of depreciation, and the last year is also going to have 11.5 months of depreciation. Here we see the first year depreciation is 11.5 months divided by 12 months and multiplying that by the annual amount, giving us about $19,000. Now for years 2 to 38, well, that's a long period of time, couldn't imagine something like that. The annual depreciation would be that amount, that $20,512. In the last year, year 39, the depreciation will again be that $19,000 amount, accounting for the mid-month convention. Now these depreciation amounts will be used to offset taxable income for the property owner, thus reducing their tax liability, sending everyone off happy because they have to pay less taxes. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.